You wrote a little bit in your book about a bubble that happened in the 60s, in the early 60s, about bowling. People thought bowling was going to be the next big thing. It was like Netflix is today, where everybody's spending hours a day doing this activity. What did you learn from that experience?
Oh, it was a wonderful early experience for me. I just got out of Stanford Business School in 1961. The hot stocks then were bowling companies. People made bowling alleys, owned bowling alleys, made bowling shoes, bowling balls, you name it, anything chalk was very important. It sounds a little absurd today, but the analysts were calculating that if we got 80% of the population to bowl, and how often it would be, they projected these incredible numbers, and so these stock prices went unbelievable heights. Well, within 6 months' time, they went to unbelievable lows, and many of them went broke.
What did you learn about bubbles from that experience?
Well, I learned how crazy people can get in terms of valuation of stocks. Periodically, we had many, many crashes that were involved around whether it was technology at one time or the internet was introduced in the early 2000s, 2006 when the mortgage bubble, everybody could get a mortgage, no problems at all about that, and boom, crash it comes. So when things get excessive valuations or availability or free money, that kind of thing, and all of a sudden corrections occur.
What's your biggest investing tip?
Well, I think right now, being tested on what the market is doing now, down 800 a couple days ago and up 400, down 800, is having the steel, having the strength to sit through it while this stuff is emotionally just really testing you all the time. Should I bail out? This is too volatile for me. I can't handle it. Look back at history. Look back at any history book of stock market. You always see this happening. Have to live through it because the big opportunity comes later, next week, next year, as the growth occurs. That's really what capitalism is all about. Growth is what we are here in America. Take the opportunity to participate in it. Hang on to your companies through thick and thin. And if they stop growing, then you can sell them and buy something else. But I have to say I'm a great fan of index funds for the average person. You get a participation in a broad range of companies, the whole of American economy, and it itself will probably grow 8 to 10% per annum for many years to come. But given, there'll be dips too, but on average, something like that.
You mentioned this volatility. We're certainly seeing a lot of that right now, fueled by tensions in the trade war. We're seeing Treasury yield curves inverted. What is your read on the market in the near term? Do you think that we're headed for a recession? And if so, when?
I don't know. Having lived through 5 or 6, 7 recessions, some economists, funny stories about economists, 8 or 10 economists suggesting there's going to be a recession and it doesn't ever happen. And so you take it with a grain of salt. You've just got to be committed to investing and don't let the press worry you into a recession is going to happen. What are you going to do? Put all your money in the bank and then that certain moment you're going to know exactly when to buy at the low. It never happens. You just have to be in play, remain with your investment through thick and thin. That's the only way to really accomplish your long-term goal.
What's the biggest mistake that you see regular, everyday, ordinary investors making?
Having inappropriate diversification. They may have 1 stock, 2 stocks, 3 stocks. That's just not enough. You've got to have at least 10 or 15 or 20, and the easiest way to do that is using index funds. That's the easiest thing to have. It's free. Diversification is free. Just buy into it.
The first time I met with Chuck Schwab, I was incredibly intimidated. I had never met someone so successful or so wealthy as Chuck. And I went in to see him about this business, and I knew every number in the deck and how we could make more money and generate more profits for the company. And when I got in there with Chuck, he kept asking me about the fees we were charging. And after asking me about all these fees, he goes, "Rick, we need to lower those fees." I said, "Chuck, if we lower fees, we're going to lose hundreds of millions of profitability." And he said, no, we won't. because we'll have more clients, they're going to tell their friends about us, and we'll do more business and we'll grow and we'll be successful.
In the prediction markets, which have been very popular of late, do you see a lot of your clients interested in investing in, if investing is the right word, or participating in prediction markets?
We're not in prediction markets today. Our stance has been that as prediction markets stand today, 90% plus of it is sports gambling. And I view that as entertainment, and if people want to sports gamble, go nuts, sports gamble. Our service to clients and our mission as a firm is to make clients better off in their financial life. We view sports gambling as, on average, you're going to lose. People are going to, 5% of people take more out of a sports gambling app than they put into it. So 95% of people are losing money, which is counter to our mission of helping people live their best financial life.
So today, based on where you see the economy, are you worried that the war in Iran might slow down the economy, or that the Fed might increase interest rates in a dramatic way, or are you not worried about those kind of external things?
As investors, we are always worried about the issue of the moment, and you could go back through time and there's always an issue in the market to worry about. Our view with clients is success is about time in the market as opposed to timing the market. Over the long run, stocks have had really strong returns and grown people's wealth. We tell clients, own stocks, stick with it, avoid the noise.